Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with Greg Peterson, portfolio manager of Mawer's Balance Strategies, and we talk a little bit about the third quarter of 2018. We cover some highlights, including emerging market currencies, rising interest rates, and a little trade deal that used to be called NAFTA. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
With me today is Greg Peterson. He's our lead portfolio manager on all our balance strategies, and we're here to talk about the third quarter of 2018. Greg, it seems like so far this year may not have been a sell in May and go away type thing. Markets overall year to date have been positive. Returns are positive. In the third quarter, there seem to be a few risks maybe rising. So why don't you walk us through a little bit of what the Asset Mix Committee was talking about throughout the quarter. We'll give listeners a sense of, I guess, where our portfolios shook out, maybe just more on the balance level. And then we'll talk a little bit more about what the investment landscape looks like now and what we might be doing to help clients out there.
Hi, Cam. Yeah, it wasn't a bad summer overall for equity investors. So it wasn't a year to sell and disappear and try and come back again. The market stayed fairly active through the course of the summer. The news flow was pretty active over the course of the summer as well. And so it wasn't really one of those quiet years. And so, as I was saying, equity markets remained pretty good. The U.S. market in particular led the way over the course of the summer. Maybe wasn't as good here in Canada, where energy and material stocks were weaker and lost over the course of the quarter. But the U.S. continues to do quite good. There's a fair bit of momentum there, despite the fact that interest rates have been moving higher in the U.S. and bond yields have also been moving higher down there. The good news on the equity side has continued to keep stock markets moving fairly positive.
Okay, so I'll pause you there and what I want to do is understand what's driving, first of all, the U.S.
So the U.S. is continuing to benefit from the tax cuts that the Trump administration implemented. So businesses have more cash to work with to either reinvest or pay out to investors for them to spend in terms. So that's helped to keep the U.S. market going much better. Profitability has been better. And so this is a bit of a late cycle kick for the U.S. economy that you wouldn't normally get. So you don't typically get fiscal stimulus injected at the time that monetary policy is starting to tighten or normalize and raise interest rates. So they've likely protracted the U.S. cycle somewhat by doing this, and it probably has a bit of momentum to carry from here for the next while as well.
So is there an argument, Greg, that we can continue to see corporate profitability and I guess the Federal Reserve move rates up gradually? Can they move in tandem, or are we going to hit some kind of point? I mean, you said late cycle, so what do we mean by late cycle? What can happen in late cycles?
Yeah, that's a great question. So they can move in tandem for sure. So typically, as you're getting into a later cycle, unemployment is running very low. And in the U.S. right now, it's sub 4%. So it's a pretty healthy time for people working in the U.S. Wages are growing and reasonably good. So it gives people the confidence to spend. At the same time, just while I'm on the consumer in the U.S., they've been deleveraging for the past few years. So consumer debt levels in the U.S. have actually improved significantly over the past few years. And so they're in a better position to spend. Typically, that would be getting into a later part of a cycle, because usually what happens at this point is that tightness in the U.S. market will start to cause inflation to rise. We have seen inflation firming and running fairly steady in the U.S. In fact, core inflation levels there are right around the Federal Reserve's target of 2%. So bumping around on either side of that, but pretty consistent for the most part. And usually at this point, you have the Federal Reserve then raising interest rates to keep inflation from running too quickly and from accelerating. And so normally what will happen then is that interest rates are rising. That'll typically bring an end to that economic growth story and sort of end to the cycle, if you will.
That, I guess, for me, the counter argument would be to that is that actually the nominal level of interest rates are still pretty low. So the risk that the Fed over tightens in this environment might be lower than, say, past cycles. Would you agree with that?
Yeah, I agree completely. So interest rates have just gotten to the point where real yields or the real interest rate in the United States has just crossed zero. So it's just positive again. So we've been in a position where interest rates have been less than the level of inflation for a long time. So that's essentially negative real interest rates in the United States, which tends to encourage and feed the economy. And we've just got to the point where they're basically flat or zero for the most part. So we're just starting to creep into that positive real rate environment. So I would expect that gives us some runway still for the U.S. economy to continue before we actually see this cycle start to age and come to an end.
Let's talk a little bit about what you have done or how have you positioned balanced portfolios at Mawer throughout the quarter. I think a little bit of that is as rates rise, there is a potential for fixed income investors to say, well, actually, I'm getting paid more, but to tilt the asset mix a little bit away from equities and toward bonds where yields are getting a little more attractive.
Yeah, so we're getting to that point where bond yields are becoming a bit more appealing. They're looking better than the dividend yield, for instance, on the S&P 500 in the United States. So investors start to weigh the risk reward between the two types of investments and eventually get to the point where, bonds with a lower risk profile at, say, 3.5% interest starts to look fairly appealing compared to a lower dividend yield that carries more risk. And so it does start to pull capital away from equity markets and into bonds. And what we've been doing with the balance fund over the course of the summer is really just to keep equity from moving higher. So we've had stronger equity markets. Bond markets have been a bit weaker, and so the relative weight of equity moves higher within your portfolio as that happens. And so we've been keeping a lid on equity, if you will, and trying to keep it around 60%. So as equity weights have moved higher, primarily from the U.S. market being stronger, we've been trimming back and basically taking some profit on the U.S. side and redeploying that to bonds and cash just to keep that mix from moving to become too risky within the portfolio.
So that's a good transition point to go from U.S. centric. So we've spent a good deal of time already talking about U.S. to Canada. I mean, there's lots of trade news. We've gone from NAFTA to, I'll butcher this one, but I think now they're pronouncing it USMCA. I came up with USMCA, or a client of mine actually said NAFTA 2.0. So take your pick, but we've had some transition there. Yet what I'm hearing in the balanced portfolio is you're trimming U.S. equities, but you're going to fixed income alternatives. You're not shifting the mix within equities. The real question I'm asking is why would you go from U.S. equity and why would you not go from U.S. equity into Canadian equities?
Yeah, that's a good question, Cam. We've been looking at that for quite some time and evaluating Canada. We've had a few concerns about potential headwinds in the Canadian economy. Trade was certainly at the top of that list for some time, and it appears that we may have NAFTA resolved or the free trade agreement moving forward. So that's reduced the risk of trade between Canada and the U.S. The other concerns that we have here continue to be household debt levels in Canada are at record levels. Debt servicing costs are increasing for households in Canada. The consumer is still a major part of the Canadian economy at roughly 2/3. And so if things become more difficult for households to afford to spend money and consume, then it's difficult for the Canadian economy to continue to grow. So we do have some concerns around that. In addition to that, we still have trouble with exporting energy out of Canada. So there's been some sort of small progress in the last little while, but it's still a risk going forward. And if you look at the price that Canadian oil companies are receiving for their product, it's a significant discount to what American companies get for oil. So, WTI right now is trading between $70 and $75 US. Canadian companies are getting somewhere in the neighborhood of $40 US for a barrel of heavy oil. So it's quite a discount here. And until we have the ability to ship our product more freely, it's difficult to see that spread changing significantly. So it is certainly a headwind for the energy sector in Canada. So far, we just haven't added much to Canada. We are underweight Canada slightly within the equity portion of the portfolios with a view to one day change that, but we just don't feel that this is the time to bring that up at the moment. Canada's got some great companies because the performance here has been not as attractive as other places in the last year and a half or so. Canadian valuations are becoming a bit more appealing. So we're just waiting for some signs that some of those headwinds are abating before we start to add here.
I like that answer. As an investor, as a balanced fund investor myself, thank you.
It's hard not to keep that home country bias and want to add to names that we're very familiar with, companies that we know very well. We know the companies very well that we invest in for foreign companies as well. But you always have that preference to invest at home. And so far, we still have a significant allocation here to Canada, just not as much as we might otherwise.
Yeah, but within the overall balanced mix, you bring in cash, you bring in fixed income, then your total Canadian weight within the total portfolio is still quite significant. So from a currency point of view, still bias toward Canadian dollars for sure.
Yeah, from a currency perspective, the balance fund is about 55% Canadian dollar and the balance in other foreign currencies.
So that's a good segue into other foreign currencies. I think certainly in the quarter, there were a few emerging market currencies that took it on the chin, so to speak. Argentina and Turkey were both over 25% down versus the US dollar. So let's get into a little bit of explanation for investors about what went on in the quarter with regards to emerging market currencies.
It's more challenging time for emerging markets in general. So typically as you have the US raising interest rates and basically pulling liquidity out of the global system, that makes it more difficult for emerging markets. So money tends to flow away from those areas. At the same time, the US dollar has been relatively strong. Many emerging markets have their foreign debt holdings denominated in US dollars. So they have the double pressure of having to pay higher interest rates for US dollar debt. At the same time, their currency is not worth as much as the US dollar, and so it's also more expensive for them to repay that debt. So those are two headwinds that emerging markets have that make things more difficult for them. And so that tends to be what happens from a macro perspective. I think some of the concerns around trade and a bit of uncertainty globally around trade has also contributed to difficulties for emerging markets. They tend to be deemed higher risk. And so if there's some concerns around trade or risk in general rising and uncertainties rising, then money would tend to flow away from those perceived riskier areas first. There were some special circumstances in the last few months too. Turkey and Argentina are two that you mentioned. Those are very much risks associated with those countries in particular and political change within those countries. So I wouldn't take what's happening there and sort of label all emerging markets the same way. Our emerging markets team does a good job of looking through to find very good companies in those parts of the world. And so there were a few countries in Venezuela I would throw in there too that's also having a very difficult time politically and socially. And so not all emerging markets are certainly going through that. So there's some great companies and countries that will continue to evolve. And I wouldn't doubt that those are areas that will find value in the near future or not too distant future, as there's good companies there that are growing and you're trying to look around the world to areas that are continuing to grow and have that upside. I suspect that that's where we'd find that at better valuations. So, while we watch emerging markets drop in the last little while and had a very weak performance, that sort of sets up your future potential for investing as well.
So what I think I'm hearing there is there might be a higher risk profile in emerging markets, but on the flip side of that is Peter Lampert runs our emerging markets portfolio, and I think he's been emphasizing companies that they reside in an emerging market, but in fact their business is global or it's international. So you get this effect where you can actually find a South Korean company whose major revenue stream is US dollars.
Yeah, and to your point, it's difficult to imagine Samsung being a much more risky company because it is domiciled in South Korea as opposed to some other part of the world. So you have household names that have very solid global businesses, just happen to be from some of those countries that get tagged as an emerging market. Let's
switch a little bit from looking back on the quarter to looking forward. So there's certainly, we want to evaluate what the risks are out there. So from an asset mix point of view, what we're hearing is we're at a neutral level. 60% equity, 40% fixed income is our neutral weight. Is there anything in the landscape going forward, Greg, that would suggest you change that?
Yeah, I think as interest rates continue to rise, interest rates are a big part of equity valuations, in addition to the direct impact that they have on bonds as well. But as interest rates continue to rise, that will pressure valuations on the equity side and make equities look more expensive as we see earnings growth continue to decelerate. That would be another indicator for us to perhaps start to reduce our equity weight from that 60%. And so we still think that currently there's a bit of momentum on the earnings side. It's still positive, and the earnings growth rate may have peaked, but growth is still positive. So that keeps us confident enough to remain at 60%. But as those start to tip over, valuations become less appealing and they're already fully valued. We don't think that they're stretched beyond what's reasonable given the environment at the moment. It's still a low rate environment for the most part. But as that changes, then we'll start to gradually change as well. We're not market timers, so we're not going to try and look for the exact perfect time to take equity lower. It's really responding to what we think is our elevating risks globally, elevating uncertainty. The picture looking forward out 2 or 3 years is becoming a bit cloudier. So when you have difficulty seeing that far out with any sense of certainty, then you start to reduce the risk you have in the portfolio, and that tends to mean reduce the equity weight within the portfolio. So we'll continue the same path as we've been down for some time now. If we go back a couple of years, equities were overweight within the balanced portfolios. We've been just very gradually trimming them to keep that from growing as a much higher weight within a balanced portfolio. We'll continue to do that going forward, and eventually we'll tip over to the point where we start to bring equity slightly underweight as well. And so that's one approach from asset mix. The other response to growing uncertainty and the change in environment too comes from the security selection. So that's where the broader teams are involved in improving the companies that we're holding. So we may not actually change the equity weights significantly, but the companies that we're holding within the portfolios, that makeup is changing constantly as well, just to make sure that we're relatively defensive if we go into if we're right that this is end of a cycle and stock markets are more pressured going forward.
Right. So something I've been hearing in research meetings throughout the quarter is from the equity teams themselves is maybe de-emphasizing holdings that are now in the top range of their fair value as we estimate it, and maybe tilting toward business models that have more recurring revenue, that type of thing.
Yeah, absolutely. So looking at those companies that have strong competitive advantages where cash flows can be seen with some certainty and fairly reliable, and also looking for businesses that have low capital needs or less capital needs going in. So if you have a very capital intensive business that's constantly having to go to the market to raise money, as you get to the point where interest rates are moving higher, risk premiums perhaps are moving higher on equities as well, the market's demanding more, it's not the best time for them to go to market to try to raise capital. So you want to de-emphasize those companies as you get into this point.
So Greg, we've talked a little bit about cycles. This one arguably is long in the tooth. That's out in the market. So what's an investor to do if out in the market, everybody's saying, we're late in the cycle, but can the cycle keep going?
Yeah, so we do talk a lot about being late cycle, and it all sounds a little gloomy, things perhaps slowing down. But investors shouldn't really worry about this. I think a lot of this talk is to help set expectations that, we're coming to the end of this. News media loves to pick up on change, and negative news, quite frankly, is attracts a lot more listeners for the most part. So I think preparing clients and investors to see a bit more of this in the news, that things are perhaps a little bit negative from time to time, or stock market volatility increases and so forth. But it doesn't mean people need to do a lot about that. I think we mentioned last quarter that really what investors need to do is make sure that they have their liquidity requirements set aside. So if you need cash in the next year for certain purchases or things that for absolute certain that are going to take place, that you have that already set up and built into your investment strategy. Beyond that, it's really setting expectations that, returns have been really good for many years now, and they are likely to slow. And so we would expect that going forward, that returns would be slower, perhaps negative from time to time, just as the uncertainty grows. That's not a bad thing. It does give your investment manager time to find new opportunities, and perhaps stocks that we followed for some time that we felt were fairly expensive. Suddenly the market has delivered them a little bit cheaper. That's better for us for making some changes. So it's really just to set expectations, ensure that your investment policy is correct for you, that you have liquidity set aside, and really just expect that the returns should naturally slow for a period of time before we start into another cycle. So it's not the end of the world. It's just a changing world.
Changing world. What a good way to end. I think we've covered a lot of ground. I think we've given people a good sense of the third quarter and what we might be doing going forward. So I'll just thank you for being here again for a quarterly review, and we'll have you on for fourth quarter and year end, and I don't know, sing a Christmas carol or two or something. I don't know. But anyway, Greg, thanks for being with us again, and we look forward to hosting you.
Yeah, thanks very much, Cam, and I'll spare everybody the singing of the Christmas carols.
Okay. I won't put you to that. Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.